Economist David Rosenberg is saying that the Bank of Canada is going to have to absolutely kill the economy in order to fight inflation, implying that there may not be as many rate hikes as expected. The definitive guide on how to manage your credit: product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so today we're going to have a bit of an interesting conversation that stems directly from the comments on this channel from the videos in the last couple of days, where people are suggesting that interest rates are almost certainly going to go to 3% or higher, and therefore people should be locking into fixed rates. Now, there's two arguments to be made here. One is that interest rates are going to go up substantially in order to fight inflation. The other, as mentioned in the intro, is that in order to fight inflation, they would have to increase interest rates so much that it would absolutely kill the economy. And that's what we're going to talk about in this video, both sides of the conversation and a balanced comparison of both sides. But before we get into it, do me that favor, hit the subscribe button, hit the notification bell, and please hit the like button so more people like you can see this video. And don't forget, this is rate week, which means our Secrets to Getting the Lowest Interest Rate course is on sale until March 7th for $47. It teaches you everything you know about how to get the lowest interest rate, how to negotiate with a bank, how to negotiate with a broker, all the other things that you can negotiate into a mortgage, and most importantly, the landmines and surprises that come along often with the lowest rates and how to avoid those. So you can go to rateseekers.ca to get that course until March 7th for just $47. And in addition to that, don't forget about our race 25,000 subscribers. We're almost there, about 2,000 subscribers away. We're going to give away $5,000 to one lucky subscriber. Okay, so let's get into the video. Let's discuss two things. First and foremost, we're going to discuss what Tiff Macklem said in his speech today with respect to the economy, with respect to interest rates, with respect to the things that need to happen in order to deal with inflation. Then we're going to discuss David Rosenberg and what he said to BNN earlier yesterday. And we're going to basically weigh out both sides of the conversation: the case for higher interest rates and the case for not so higher interest rates after a couple of increases here. So let's start first and foremost by jumping into the screen here. This is from the Bank of Canada's website. It is the prepared remarks for Tiff Macklem, and it is basically talking about several things here. If you scroll down and you get into the bullet points here, the understanding the unusual rise in inflation bullet points, this is a really good description of what's happening right now and why inflation has run so hot and continued to run so hot even after the Bank of Canada and the Federal Reserve in the US predicted that inflation would be transitory and that it wouldn't last for an extended period of time. So first and foremost, they talk about the fact that people have been stuck at home during the pandemic, and therefore the amount of money that they've been spending on goods has increased, and the amount of money that they've been spending on services has therefore decreased, which means that the demand for goods has gone up, and therefore prices are rising because of that excess demand. Now, they've also talked about the fact that there are things that in the supply chain that have been affecting prices as well. Things like higher oil prices, which leads to higher transportation costs, which leads to inflation in pretty much any good that needs to be shipped. And also the fact that food prices have continued to go up, primarily because of weather issues in the last harvest season. And of course, the strong demand for single-family homes. All of us are well aware of this. All of these things have led to higher than expected inflation. And in addition to those, the overall strength of the Canadian economy and the recovery has been greater than expected. So these are all the things that have been leading to higher rates of inflation. And as David Rosenberg points out here in a minute, a lot of these have to do with supply and things that the Bank of Canada doesn't have necessarily direct control over when it applies monetary policy. So in other words, you can affect things like the price of oil by increasing interest rates, because things like the Russian-Ukraine crisis has significantly greater impact on oil prices than a 25 basis point increase in interest rates. Now, the other thing that he talks about here is quantitative tightening. We all know about quantitative easing. Quantitative tightening is the opposite. This is where they stop buying back bonds and as a result create less demand in the bond market, which means higher long-term interest rates. So 5, 10, 15-year rates could go up by virtue of the fact that the Bank of Canada is not going to do quantitative easing anymore. They're going to do quantitative tightening, and they're basically going to lessen the amount of demand in the bond market. Now, why is this important? It is extremely important because the monetary policy tool, which is the interest rate, isn't the only tool that the Bank of Canada has at its disposal. And as a result, they can use quantitative tightening to also have a greater effect on things like 5-year fixed rates and fixed rates on pretty much any sort of borrowing in the economy. And expect that they will likely use this and that long-term rates will go up sometime in the future by virtue of the fact that they're going to use this quantitative tightening tool at some point. Now, here's where the conversation gets interesting. This is David Rosenberg, and this is the headline. Bank of Canada will have to kill the economy to crush inflation. And this is a really interesting conversation and a valid one, because unlike the people in the comment section who say interest rates are almost certainly going to go up, so you should be locking in even though you've got 1.5% difference in the rate you would be locking in at and the variable rate that you can get, well, this is the conversation around why interest rates may not actually go up, even though it seems like they have to in order to deal with inflation. And by the way, at the end of this video, I am going to talk about what I think is going to happen with inflation in the long term. So first and foremost, he argues that most of inflation that has emerged during the pandemic has stemmed from supply side issues, such as global supply chain disruptions, which is much harder to rectify with monetary policy compared to tackling inflation caused primarily by household consumption. So in other words, what he is saying here is that a lot of the issues have to do with worldwide supply chain. In other words, getting goods to Canada at a reasonable price. And if you try to cut off demand, so household spending, well, essentially what you would be doing is you would be penalizing people for spending money via higher interest rates, but you wouldn't actually be able to impact the prices because those supply chain issues are external to the Canadian banking and the Canadian financial system and the Canadian economy as a whole. We can't control things like how fast goods are getting here and supply chain blockages and semiconductors and all of those things. So basically, there's a choice to be made here. The choice is, first and foremost, you can increase interest rates, which will reduce the amount of household spending. And reducing the amount of household spending will obviously reduce the amount of demand, which will reduce, hopefully, prices. But here's the trade-off. You will have less money because there will be less activity in the economy and less ability to purchase goods because you will be making less money because the economy will not be able to pay you the money in order for you to purchase those goods. Now, on the other side of the equation is inflation runs hot, everything gets more expensive, but the economy runs at full tilt, everybody gets higher wages, maybe not to the extent that we would like, but wages flow through to the consumers. And as a result, we end up with higher prices, but we also end up with higher incomes and enough growth in the economy to support the higher prices. So either way, we're either choosing between higher prices and growth in the economy or lower prices and less growth in the economy. And the trade-off is essentially that you're going to have to choose one or the other. Now, when you factor in the fact that there's a lot of people out there with variable rate mortgages, and there are a lot of people out there with HELOCs, and there's a lot of lending happening in the last couple of years. Well, if you raise interest rates too fast, the amount of hardship that it could create is huge. Now, given the current political landscape of Canada, I would suggest that there would be an emphasis more towards avoiding hardship and maybe not increasing interest rates as fast. As opposed to if there was a more conservative government and a more conservative landscape, there may be some tendency to, have the hardship be a side effect and increase interest rates and therefore get lower prices. So I think given the current political landscape, I think where we're going to go is probably less interest rate increases. I'm more on the side of what David Rosenberg is saying than I am on the side of higher interest rate increases. But again, that's just my personal opinion. Now, there's a whole bunch of other things that go along with this, but basically the gist of it is this, is what David Rosenberg is saying is that in order for the Bank of Canada to deal with inflation and snuff it out the way that they're suggesting that they're going to, they are going to have to increase interest rates quite substantially. And Rosenberg is just basically saying it's not going to happen. You're going to have 2 or 3 interest rate increases. And at that point in time, the effects on the economy are going to become clear. And in my opinion, I think what's going to happen is that for the next 2, 3, 4 years, we're probably going to live in an environment where we see 5, 6% inflation rates as opposed to higher interest rates. That just, to me, from a gut feeling standpoint, seems to feel like what is going to happen, because I don't think that the current political landscape is going to allow higher interest rates that basically put people into bankruptcy. Things getting tighter on a price side, higher priced groceries, higher priced gas, higher priced housing. Those are things that essentially can be dealt with as long as wages are following along. But higher interest rates and significant amounts of pain with respect to higher interest rates is just something that I don't think the government will have an appetite for. Now, the Bank of Canada operates independently from the federal government, so they have their own say and whatnot, but they do have pressure that gets filtered down from the government, and they're going to have to deal with that and what the sentiment is in the economy. So I really believe that as of right now, that's what we're looking at now. That being said, I've been talking about low interest rates for a long period of time. I've been clear on the fact that that's been my prediction, and therefore I'm probably a little bit swayed in the direction of David Rosenberg as opposed to being swayed towards higher interest rates. At the end of the day, the reality of it is this, and this is really simple. Regardless of what I think, regardless of what Rosenberg thinks, regardless of what any economists think, we don't know what's going to happen. We don't know how this is going to play out. We can make our best guess, like the Bank of Canada and the Federal Reserve did back in 2020 with respect to when inflation was going to go away, but more than likely we're going to be wrong. So the only thing that I can decipher with respect to how to choose a mortgage is the old saying, a bird in the hand is better than two in the bush. And right now, it continues to be really easy to make a case for variable rate mortgages because you've still got 1.5% worth of interest rate increases or 1.25% worth of interest rate increases, where you'll still be saving money compared to if you had a fixed rate mortgage right now, which means you have this opportunity, 5 interest rate increases to save money. And then after that, you're going to need several more in order to cancel out the amount of time where you've been saving money. So I'm just a big believer in that bird in the hand. And you know what? We might get it a little bit wrong, but even if we get it a little bit wrong and interest rates go up 10 times, we're probably not going to pay substantially more for our mortgage than if we had chosen a fixed rate anyways. And in the event that Rosenberg is right and interest rates don't go up as much as we expect, well, then we end up winning because we end up with this mortgage that never got to that 3% interest rate if we're lucky. So I'm willing to take the gamble on it. It comes down to your own personal risk tolerance and what you think. Best way to do that, download the mortgage calculator that's linked in the description below. Figure out what the difference in payments is. That difference in payments is essentially your insurance cost. And then figure out for yourself if you are willing to pay that premium in order to know exactly what your rate's going to be for the next 5 years, as opposed to saving some money right now with the risk of payments going up. Oh, and one last thing. Don't think that taking a 5-year fixed rate protects you from rising interest rates. It doesn't, because a 5-year fixed rate is really a 5-year adjustable rate. The payment will adjust in 5 years. So if you do believe that interest rates are going to go up, you're basically just pushing out the inevitable, and you could feel a really big interest rate shock 5 years down the road. So my advice and my thought process around this is always to take an adjustable rate mortgage where the payments increase as interest rates increase and also decrease as interest rates decrease, so that you feel the pain of rising interest rates gradually over time instead of all at once. Because the real risk is not the people who chose adjustable rate mortgages and dealt with them for the next 5 years. The real risk is if interest rates do go up and you've got a 5-year fixed, seeing your payment jump substantially overnight when that mortgage comes up for renewal. So if you found this video useful, do me that favor, hit the subscribe button, hit the notification bell. Don't forget about that Rate Secrets course and the race to 25,000 subscribers, and we'll see you on the very next video. Cheers.